Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning and a warm welcome to my podcast Money Talk for Monday the 5th of June. We're currently ranked number 8 on Apple Podcasts among all finance and investment podcasts in Hong Kong, so thank you very much for listening to the original Money Talk. We're also available on Google Podcasts and Spotify. And this podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, President Joe Biden signed into law over the weekend the Fiscal Responsibility Act of 2023, ending a weeks-long political standoff over the debt ceiling, with just days to spare before a potential unprecedented default on US debt. US jobs growth was almost twice as strong as forecast in May, and the prior 2 months' payrolls were revised up by nearly 100,000, complicating the Fed's next decision on rates. The US economy added 339,000 new non-farm jobs last month, exceeding the revised 294,000 increase in April, and above economists' forecast for 195,000. It marked the 29th straight month of positive job growth. China is reportedly working on a new package of measures to support the property market after Beijing's comprehensive 16-point plan from November failed to sustain a rebound in the ailing sector. Regulators are considering reducing the down payment in some non-core neighbourhoods of major cities, lowering agent commissions on transactions and further relaxing restrictions for residential purchases. The influential group of oil-producing nations known as OPEC Plus made no changes to its planned oil production cuts for this year at its meeting in Vienna on Sunday, but Saudi Arabia announced further voluntary declines of 1 million barrels per day, which on top of existing cuts will last until the end of 2024. On today's programme, I'm joined by Alex Wong, Director at Alex KY Wong Asset Management, and David Friedland, Managing Director of Asia Pacific at Interactive Brokers. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks surged on Friday as traders cheered a strong jobs report and the passage of a debt ceiling bill that averts a US default, putting them on the verge of a new bull market. An advance of almost 1.5% for the S&P 500 to 4,282 extended the benchmark's surge from its October low to nearly 20%. The Dow jumped 701 points, or 2.1%, to end at 33,763 in its best day since January. The Nasdaq Composite advanced 1.1% to 13,241, reaching its highest level since April 2022 during the session. The Nasdaq notched its 6th straight week of gains. That's a streak not seen for the technology-heavy index since 2020. And with Friday's advances, the S&P 500 and Nasdaq finished the holiday-shortened trading week 1.8% and 2% higher respectively. Hong Kong equities surged in their best day since early March, boosted by internet stocks. Investors snapped up shares on hopes that a protracted sell-off for China stocks was overdone. The Hang Seng Index jumped 733 points, or 4%, to 18,950. The rebound followed weeks of selling that pushed the benchmark 20% lower from its January peak and into a bear market. The internet, consumer and real estate sector steered the index's gains. Investment holding company Longfor soared over 17%, and automotive company Zhongzheng Group surged 11%. Sportswear company Li Ning added over 11%. The Hang Seng Tech Index jumped 5.3%. Tencent and Alibaba closed 6% and 6.7% higher in Hong Kong, respectively. And futures markets suggesting the rebound will continue this morning, with the Hang Seng rising around 160 points, or 0.9% at the open. And oil prices have surged out of the gate in early Asian trading this morning following the surprise 1 million barrels a day production cuts by Saudi Arabia. Brent crude oil is currently up around 2.5% at $78.03 a barrel. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk.
Peter Lewis's Money Talk.
Let's welcome our guests. We have with us Alex Wong, who is Director of Alex KY Wong Asset Management. Morning, Alex.
Good morning.
And also joining us this morning, David Friedland, who is Managing Director for Asia Pacific at Interactive Brokers. Welcome, David.
Good morning.
US jobs growth was almost twice as strong as forecast in May, and the prior 2 months' payrolls were revised up by nearly 100,000. The US economy added 339,000 new non-farm jobs last month, exceeding the revised 294,000 increase in April, and above economists' forecasts for 195,000 in an unexpected sign of the resilience of the US economy ahead of the Fed's next rate-setting meeting, which is on the 14th of June. It marks the 29th straight month of positive job growth, and the increases were widespread, with notable upticks in professional and business services, government and healthcare, according to the figures published by the Bureau of Labour Statistics last Friday. Alex, this is almost double what economists were forecasting, well above the highest forecast. The Fed had been hoping to see its interest rate rises cause the economy to slow more, and that was supposed to curb wage and price increases. So where does this jobs report fit in with that hope, if you like, of the Fed?
I think this means the U.S. economy actually is much more resilient than we expected, and this is really surprising given we had a banking crisis in U.S. and SME actually would be difficult to get funding that easily, as compared to the past. So I think this is a bit surprising, and that makes the Fed actually a bit probably tilted towards holding a tighter positions.
I mean, it's odd, isn't it? There just doesn't seem to be any sign of a recession on the horizon, even though that's what people are predicting. It just doesn't seem to be coming at the moment.
Yeah, right. And the only thing I think is good is that we have a pause in the commodity in prices, especially in the agricultural products. So that probably is the bright spot.
David, what do you make of this? I mean, why is it that these rate hikes that we've had for, over a year now just don't seem to be cooling the jobs market? There just seems to be, a surge of availability of jobs.
I think it's just a really strong economy and a lot of demand in the tech sector and elsewhere. But there is a glimmer of hope where the unemployment rate actually ticked up. Even though there have a huge surge in jobs, there was more unemployment, which part of that I've been reading there's a bit of lost productivity. Productivity is way down. I guess that's because from the work from home change in the whole lifestyle of how the working force is going about. But with that ticking down, there's the indication I think is about a 64% chance of an interest rate or a pause for maybe a month or one more tick up. But I think we're towards the end of the cycle, and it's not as I don't think it's as tight as the numbers indicate it may be not as tight as they are at first blush.
And suppose one positive was average hourly earnings. It looks like that's sort of trending downwards, doesn't it? Which presumably the Fed is going to be pleased about. Yeah,
and I think it's also possible that you had a lot of people leave the workforce thinking they don't have to work again, but now with prices coming up and maybe they wake up and say, well, I have to start working. So maybe that's where some of this, the tick in the unemployment rate is coming up and people looking for different types of jobs realizing they can't be as selective as they have been in the past.
There's this rule known as Salm's rule, named after Claudia Salm. She was a former Fed board economist, and her rule says that if the unemployment rate increases by 0.5 percentage point within a 12-month period, that's supposed to be an infallible recession signal. Well, we're there. It has done that. Do you think a recession is on the horizon?
I think somehow we're just avoiding it. Though every time you turn around, the markets are strong. The economy is strong. There's demand for labor, and earnings are pretty good. But the hidden one of the hidden things, though, do you think the markets in the U.S. particularly are up 12% this year? But it's really is driven by tech. You take the tech out of it, we're actually in a pretty bad market. So I think it's a toss-up still. I don't think we're out of the woods yet.
So, Alex, now that this debt limit drama is all over, the bill's been signed, does now the focus return to the battle against inflation and what the Fed is going to do? Is that going to be the major concern now of investors?
Yeah, of course. I think this is still a very data-dependent market, so we probably would look at the CPI very closely in this market. And But the sentiment actually is quite bullish. I think on Friday, actually, what we see is the string is spreading out to the broader sectors. So we are seeing a rotation out of tech and into those traditional names. So probably the market will remain strong for a while.
Wherever we look around the world, it seems that inflation has topped out and seems to be on a declining trend, doesn't it? Not just in the US, but all the major economies. We saw that in the Eurozone data as well. Do you think there's enough now for central banks to sort of declare some sort of victory over inflation and maybe stop with these interest rate hikes?
Hopefully, yes, because actually I think we are already seeing peak in the commodities market. And what is supporting the inflation is in the wages. And also I think there's some structural problems probably in the supply chain. But that kind of problem actually I think probably would be solved as time goes on. So I think we probably may see the inflation already close to peaking and probably the chance of further rate hike actually would not be that. Chance of further big rate hike actually would not be that big.
David, do you think the Fed can, claim success here? Maybe they've brought inflation down, or at least stopped it rising anyway, without causing a recession.
I think they're going to start to, because it's a lot of inflation is psychological. So it's if your food prices go up, you keep raising your costs, and you're anticipating what's going on. You have to maintain your cost of living. But if they get past the psychological barrier and they start pushing maybe a little bit of unemployment a bit further, I think we'll settle down and they may actually have a soft landing that we weren't so sure about 6 months ago.
So what does the Fed do? They're talking about, well, they're being a bit careful with their language, aren't they? They were talking about a pause, but they don't want it to be known as a pause because that gives the impression that we're going to stop raising rates. They want it to be called a skip now, so they're going to skip a hike this month, but it looks like they're going to carry on raising rates the following month. Is that your interpretation as well?
It seems that way, but I think they want that perception out there, thinking, hey, rates are going up, we have to slow down a bit. And again, I think they're feeding the psychological aspect of inflation.
But what's the point of waiting a month? What are they going to know in a month's time that they don't know now? It seems an odd thing to do, doesn't it? To basically signal we're not going to raise rates this month, but we will again next month and carry on.
Well, I think maybe it gives them the chance to say, we're going to skip this month. Hey, guess what? Things are not so bad. Let's skip the next month, too. And they can kick the can down the road and just see what figures come out.
Well, what do you think, Alex? Did they make a mistake, maybe? Should they not have? Because they had all the officials out signalling this pause before they'd seen this jobs data. We've still got another month of inflation data to come yet before the Fed meets again. Did they make a mistake there, maybe, in doing that? They should have waited for this jobs data, which is really pretty strong, isn't it?
Yeah, I think actually it seems better that they wait after this job data because they probably are still quite data dependent. Yeah. And if the CPI surprises, then probably they would be expected to wait further again next month. So anyway, I think this pause actually means very little as they are still quite data dependent.
So where does China fit into this inflation sort of picture? Because in China we've got slowing growth and sort of almost a disinflationary trend now, haven't we, going on the mainland? Is that going to have an impact on the US and everywhere else on their inflation as well? Because it's been bringing down the prices of commodities, hasn't it, and other things. Are they going to export this deflation elsewhere?
I think in the meantime, no, because I think in the world elsewhere, actually, first of all, the inflation is supported by the tight labor market, which I think is not happening in China. So apart from commodities, actually, I think the factors supporting inflation actually is not that related to China.
But David, things are not well on the mainland, are they? If you look at some of the signals, real estate activities declining, house price growth is low, yields have started to fall again, imports are dropping. There just doesn't seem to be the demand at the moment. It's all stagnating.
Yeah, I think a lot of that, again, some of it's psychological. It's getting out of the COVID. It just takes it's a very big ship. It has to turn very slowly. But I think that the big issue there is the mountain of debt in real estate developers, and I think it's 12% of GDP. So they have to slowly dig themselves out of that. And then once the property sector starts turning around, people's psychology, they feel more positive about their market. People have so much money tied up in real estate, they don't feel wealthy unless it's going up. Maybe that's part of it. But as China, if you go, it's booming. You walk around, they're starting to travel again. They're starting to shop. They're starting to get out. So I think it just takes a little time to turn around, but it'll happen.
We're seeing outflows, aren't we, at the moment? I mean, if you measure the difference between the trade surplus, which is at a record high, and then FX reserves, clearly that booming trade surplus is leaking out of the country. Do you think the authorities are going to be concerned about that? Maybe that's why the yuan's depreciating.
I think they're always concerned about money leaking out. It's a very tight policy, but at some point that'll balance out. It's just how it always happens.
Now, Alex, what do you make of these new property market support measures? China's reportedly working on this new package of measures following its 16-point plan in November, which really didn't work, did it? They're considering reducing the down payments in some non-core neighbourhoods of major cities, lowering agent commissions on transactions, and further relaxing restrictions for residential purposes. The property sector, Alex, still a big drag on the mainland economy, isn't it? Is this new package of measures, assuming it happens, is it going to work?
I don't think so. I think it will not work. I think the demand actually is structurally declining because I think, first of all, young people actually do not seems to have that kind of urge to buy a property, because actually many Chinese youth feel quite desperate, and they are not getting married, and they are not having new children, and actually they probably would inherit quite some properties from their parents and their grandparents. So that means that the long-term demand actually is declining, and I think that actually will still be the problem in China. Actually the demand for properties actually is from the expectations of rising prices. And actually, if that disappear, then the demand actually would be very bad, because I think in China you don't need that much property, that many properties in a declining population.
So that's why the 16-point plan from November hasn't worked either. It hasn't really stimulated demand, has it?
I think you need to give hope to people, to let them have some hope for sustainable wealth generation, to have a sustainable demand for the property market. And also, I think that needs some hope for them to get married and get children.
But the market likes this, but then I suppose that there hasn't been any property support measure that the market doesn't like, but it's loved it on Friday, this report.
I think that you cannot judge the performance on one day, because the market had been in consistent selling pressure for quite some time. And actually Hong Kong is a derivative-driven market, so the short covering strength actually would be much stronger than normal than other markets. So I think this is just a very short-term relief rebound. And probably propelled by short covering, which will not be sustainable. I think this is a good chance to get some chips out of Hong Kong and China.
Okay, I want to talk more about the markets in a moment. David, before that, let me ask you about what you think about these reported, because they haven't been confirmed, it's sort of reported property support measures, but as we said, the market likes it. But do you think it's going to work?
Well, I think Alex hit the nail on the head. It's the bigger picture out there, and it's actually a global issue, is the population growth. It's the young generation don't see the same opportunity the previous generations have had, and plus they inherit property from their current families, and they just aren't going out there and building the need to have more homes. And there's a big oversupply in China, and that's going to take a long time to soak up.
And as you mentioned earlier, property developer debt is about 12% of China's GDP, and quite a lot of that is at risk of default. I mean, that's a big overhang as well, isn't it?
I think it's massive, and it's going to take. You can't just get rid of that overnight. It's going to be a slow burn to catch up. So they overbuilt so fast, and it's like in the markets, everyone's happy when markets are rising exponentially, but they're just as dangerous because when they collapse, they they go fast, and they put people in a funk for a very long time.
It was interesting last week. China Evergrande Group says it faces more than 1,000 lawsuits now, involving 350 billion yuan. That's about just over 49 billion US dollars, and they're not the only one. Either, but it just shows, doesn't it, just how much this presumably it affects financial stability on the mainland, doesn't it?
Yeah, if there's 1,000, there's probably 1,000 more that we don't know about, or just seeking to file as well, or that are being heard, or just turn the other way. That's probably just the tip of the iceberg, but we don't know. There's always you always throw good money after bad.
Well, let's talk about the markets a bit more, Alex. You started off with on Hong Kong. It is the best day since early March, but it sounds like from what you're saying that this is a good opportunity for people to get out. Was this a technical sort of rebound? Because if you look at things like the RSI, it dropped below 30, didn't it? Which is a sort of signal that things are oversold. Is that the main reason why we saw this big jump?
Yeah, I think we have been in a very bearish mode for quite some time, and the market actually has consistently down. And on Friday, actually, it's also propelled by the rebalancing of the HSI, because the index fund actually has need to pop up their percentage holdings in tech. So that is supporting Tencent and probably Meituan as well. So I think this is just a technical rebound. This is not a reversal. And it's very difficult to have a reversal, I think, in China. So very likely we would continue the bearish trend. I think in Hong Kong, the typical trend would be we would be down slowly, and then we have some very quick rebound for 1 or 2 days, and then we start to decline again. So I think that probably would persist for quite some time.
Are you, I've seen some analysts at some of the big investment banks saying that, there are stimulus measures coming, geopolitical ties are improving, so the earnings are not too bad. So that's a reason now to turn bullish on Chinese stocks. But you don't sound too convinced by that argument.
Yeah, right. Because I think that the whole big theme for the global market right now is AI. And so AI is sucking up money from investors elsewhere. And then for China, I think this is very difficult to play that film, because for AI companies to get back, actually, I think they need to avoid government regulations, severe regulating. But in China, I think people are very concerned about government regulation. So it is very difficult to imagine a Chinese version of Microsoft or Chinese version of NVIDIA to come out, because first of all, they do not have that kind of technology in semiconductors, and then you probably have the bigger risk of government regulating. So I think it's very difficult to pop up a AI bubble in China. So if people are very very concerned about that, I think they probably would go elsewhere to put their money on. So I think this is why China consistently underperformed the other markets in May, because in May actually people are going crazy for AI films, and I think this AI film actually would be in the market for quite some time. So China actually would be underperforming.
So in Asia, you would go to places like Taiwan, South Korea, Japan. Is that sort of sucking money out of China? Because there you can play the AI theme, can't you?
Yeah, right. I think even Japan actually would be benefiting from this. So we are seeing money going for other markets. And if you want to pay China consumer markets, actually you buy LVMH and Hermes. So I think that's why people are not going towards the China equities, because you can pay the China markets using other markets. People call them the passport companies, because you have the passport to go in and go to do the business, and they actually have other markets to support. So that is less risky than you are paying Chinese companies, because Chinese companies only concentrate on their local markets, because not many Chinese brands actually had the power to go global.
David, do you think this is a turning point for Hong Kong stocks? What are your thoughts? Because it was a dreadful month in May, really, wasn't it? As Alex has just said, we really underperformed pretty well every other global market.
I think it's a positive sentiment in that, Hong Kong is very sentiment driven. So you get some positive news out, it goes in trends. I think it's going to follow a lot of what's happening in the States in particular right now as the markets go up. But Yeah, I think there's a big hanging. There's a looming danger out there. There's a big storm coming. I think with in the S&P 500, I think it's the most bearish sentiment since 2007. You take out the tech, it's a very bearish market. So Hong Kong doesn't have that kind of tech. It's financial, real estate. It's a lot of China stocks. So without that driving, that looming danger is happening, and the bears tend to be right. It could get ugly out here.
But presumably then, if we don't have those types of stocks which are holding up the US markets, if there is a collapse, China could outperform, couldn't it? Then that might be the time to actually start looking. Because if you go back to when we were last oversold, which was back in around about October, we then saw almost a 55% rebound from those lows. So maybe we might see it again.
You have a good point, and you could be right, and that's why I'm not pregnant. I don't guess the markets. I just offer what's out there. But I think you might be right. But Hong Kong is still beholden in the demand. I mean, we got hit very badly because of COVID. We were locked down for so long. The China stocks, the same thing. Obviously that's what took us. The earnings have been driving Hong Kong market and hasn't been strong. I guess it's really going to come down to earnings growth. But if the U.S. takes a big hit and the economy starts going down, then that'll cycle out here as well.
Let me ask you a bit about the U.S. markets. The tech-heavy NASDAQ 100 up 33% so far in 2023. The S&P 500 up about 11.5% year to date, but it is at a 10-month high. But these 5 stocks, Apple, Microsoft, Alphabet, Amazon, Nvidia, they account for 25% now of the S&P 500's value. That's got to be a concern, hasn't it, when now the whole market is so dependent upon just 5 stocks, and you almost worry, well, what happens if those 5 stocks start to decline?
Yeah, I think it's a very big concern. Knowing what happens in the States, will just rejigger the index to put in whoever hot and heavy at the time, because if you look at the composition of the Dow over the years, it's completely changed from industrial to tech. But Nvidia, I mean, the valuation is it's $1 trillion. It's out of nowhere.
First chip company worth $1 trillion, isn't it?
So I without looking at the numbers underneath it, for my first reaction is that's crazy. But the demand is going to be wild. They're dominant in the market right now. So who knows? But those companies are dominant in AI. They're going to continue. They're going to keep driving the market share, but I think they'll spin off a lot of other companies. There'll be opportunity around it, and we're actually entering a new phase where is this AI is going to take us? Is it going to create jobs? Is it going to take jobs?
What do you do? Because obviously you're head of a big financial firm out here. Is AI very much on your agenda? Is it something that you're thinking about in terms of either the risks of it or the opportunities? How could it sort of transform the brokerage industry, the financial industry? Is it something that you're thinking about a lot? Absolutely.
I mean, on the first, the lowest hanging fruit is the basic client services. The clients come in, right now, people want to speak to a person, or they go to a bot, and the bots online are so right now. I mean, I'm sure we've all probably had to go to a service site. You ask a question, and it drives you crazy when the bot doesn't answer the question. You come, I want to talk to a person. It doesn't come back with a proper answer. But as the intelligence picks up, and you're talking to someone who seems like a human, and you're getting proper answers that are accurate, it's going to transform the service industry. Mm-hmm. On the other hand, it's going to. This is something I thought about actually years ago. If everybody's following the same bot, so they have AI out there and all predicting the same thing, which is inevitable, does that mean everyone's buying the same stock? Are we all buying the same clothes? I don't know. So
interesting.
I don't know where that's going to lead, but at some point there has to be two sides of a market.
But it is something very much that's on the agenda of you and other financial firms.
Yeah, and I don't know if it's going to increase volatility or because of one-directional flow, or as a way of tempering volatility because everyone thinks, well, the market's going to be here, this is where it should be, let's all get to that level.
Alex, let me get your thoughts on the US markets. If you look at the S&P 500 equal weighted index, which gives an equal value to every stock, it's actually down 0.35% since January. So are you worried now about the concentration in the US markets in just a small number of names?
Yeah, I think first of all, the strategy is to rotate out of tech. Actually, this is time to reduce some weight on the tech sectors, and I think people actually are spreading out to other sectors like financial and consumer staples right now. So I think the strategy is to hope the market actually would take some chips out of the tech sector and going into other sectors. Right now, I think this is the strategy to play the market. I think we are seeing that on Friday already, and that probably was just a start. So we probably may see the market to hold relatively strong, and then we are seeing strength in other sectors other than tech to sustain the current level. So I think sector rotation probably would be the theme, but the overall risk actually is higher right now because probably as time goes on, the recession fear would play out, and we probably may see a correction coming. So the strategy is to reduce the highly value tech and going into those under pressure traditional companies right now.
Do you worry also now that this debt ceiling crisis is over, the Treasury, it's got to go on a massive borrowing spree, hasn't it? Some estimates say maybe it needs to raise $1 trillion by the end of the third quarter. That's going to drain a lot of liquidity out of the economy, isn't it? Is that a worry?
Right now, not much, because the market actually is quite resilient, and you are not seeing a sharp fall in treasury prices. They stabilized. So I think the market expectations actually is okay. But the point is you probably just buy some gold for insurance on the current level. So that is the strategy to pay and hedge that risk. But I think the overall market performance means the market actually do not care too much about that kind of fundraising by the U.S. government, because we have seen that before. So I think people are not too worried about that.
When we've seen this before, David, in the past, when you see this type of liquidity drain, it almost always leads to a decline in stocks sort of overall. There was one measure that says with the Fed tightening, liquidity is going down at an annual rate of about 6%, and that was in contrast to growth in liquidity for most of the last decade. So is it a risk we should be worried about?
I don't know if it's a risk because it's out there. Markets go up, markets go down. I think it's healthy. It all balances out. They do have to raise money. Everyone knows it. So I think we're okay on that front. I think the bigger concern is what's looming at 2 years ahead from now. And this constant cycle of is politics overdoing, posturing in politics over what's happening in the real, what you need to do, the right thing.
It's interesting, isn't it, that Fitch have said they're not going to reduce the negative watch on America's credit rating because of exactly what you said. This could all happen again in a couple of years' time.
Yeah, I think it's a bold move, and I think it's the right move. I mean, you just went through. I mean, it would have been a disaster if the U.S. defaults on its debt. Everyone knows that, but you still have politicians out there saying, "I don't care. I don't want to spend here. I don't want to spend there," and instead of really getting together. So hopefully we move towards a more bipartisan world, but I'm afraid we're not.
Well, while we're talking about risks, let me ask you about a Bloomberg survey of 53 economists, money managers and strategists at financial institutions. They range from sovereign wealth funds to banks and pensions. And they've been asked what they see as their main concerns, their main risk. Well, the number one risk on their radar screen is China local government financing vehicles, LGFVs. That's most cited as the top risk in this survey. That's followed by mortgage-backed bonds and loans. Number 3 is frontier market sovereign debt loans. The fourth risk is South Korea project finance stress. And then finally, Japanese banks. So let me ask you about these local government financing vehicles in China. Goldman Sachs estimates China's total government debt is about $23 trillion. The total debt of these LGFVs is estimated at about $6.5 trillion. So, do you concur with those concerns that this is something now that we ought to be looking at?
I think, of course, that is a risk because with a bad property market, actually, that it was very difficult for those local companies to raise funds. And that's why I think China is promoting those SOEs this year, because they probably would need to sell other kind of assets other than properties to try to raise funds for the government. But the good thing is in China is that China is a country with a very huge domestic savings. And also the national government debt level is that concern. So we are talking about the local government level only. So if they can promote the local people to try to switch some of the savings out to investment into those SOEs, actually that would probably help to reduce the problem.
But I suppose it has a knock-on effect on the economy, doesn't it? Because these local governments, municipal governments, they can't raise new money at the moment, or it's difficult for them to do so, which in turn means they can't support their local economies at the moment. So it's sort of having even if you don't think it's going to turn into a crisis, it's certainly having an economic impact, isn't it?
Yeah, of course. That's why China actually has all kind of problems in the meantime. I think that's why they try to repackage the businesses holding by the governments into some kind of listed companies and try to raise funds from the in the stock markets. I think that's the plan to get out of this problem. Because if you cannot sell land, probably you can sell business involving bridges and other kinds of infrastructures. So I think that's why they are promoting the SOE, because the valuation is so low, so the efficiency of that kind of fundraising actually is quite low. But if they can get a higher valuation, I think they probably would be likely to promote. And you can see they are doing this kind of assets into the form of REITs. So probably we are seeing that kind of REITs to come out more in China markets.
David, what's your thoughts on this? Is it a concern on your radar?
Well, it's definitely a concern. I think the property market in China is going to guide so much, and if they can work out of it smoothly and softly, it's going to make a big, big difference, sentiment-wise, obviously monetary-wise. But as Alex said, there's a great amount of savings in China, and I think they'll find ways to dig that up and hopefully get that invested.
I mean, this is, there's also all the hidden borrowing as well that we don't know about that's on top of this. All these financing companies have been set up by the provinces and the cities. There's a lot more there than we know about, isn't there?
Yeah, it is. That's always the devil that you don't know. I'm sorry, the devil you know, but this is what we don't know. And let's see what pops up. But if things start getting shaky, that stuff tends to filter itself out. It corrects itself. And then sometimes a little correction is not bad for the world, bad for the market. It help pick things up. You build from the bottom and start again.
Do any of those other worries that were on the list, mortgage-backed bonds and loans, frontier markets, Japanese banks, are any of those a worry for you? Or is there something that you're concerned about that isn't on that list? I
think they're all hidden. I think the biggest worry is political tensions. You have all the businessmen, Elon Musk, you have Jamie Dimon coming into China, but the military still won't speak. We got to get that has to be cleaned up in some shape or form, and hopefully, military conflict isn't the way out of some bad markets.
What's interesting is that China's welcoming those business leaders with open arms. I mean, Elon Musk got to see some of the top ministers, so did Jamie Dimon, but at the government level, they just don't seem to be speaking.
It's amazing. They're doing their best to, hey, we're opening up, we're bringing in securities companies, we're going to increase the flow of capital and investment, but then when you get to the top levels, it's just a brick wall.
Alex, anything on that list that particularly worries you, or anything that's not on the list that worries you as a risk that we should be watching out for?
I think the talk on the commercial real estate market in the U.S. actually is not on that list, but I think that is a real risk because I think for commercial real estate, the long-term demand actually is diminishing, and the value actually is quite high. So I think that kind of problem actually may also lie in the regional banks as well. So that's I think is another risk that is not mentioned in the list.
And that's presumably because firms don't need big offices in downtown locations anymore, do they? The work ethic has changed.
And also, I think the problem is SMEs actually is losing in the war, in the commercial world. They are more difficult to get financing, and because of the regional bank crisis, and also if you are talking about the big AI era, then probably SMEs will be losers, because they probably do not have the kind of resources to get into the AI war. So I think that also will reduce the demand as well. So that's why I think the commercial real estate actually would be the problem in the long term.
So we had these worries about banks sitting on US government bonds and their unrealized losses. Their unrealized losses on mortgage-backed bonds could be huge, couldn't they, if we start to see a protracted decline in commercial real estate?
Yeah, that's why this is a problem of concern. So if we see that kind of decline in the commercial real estate, actually that will spread out in the other sectors.
Well, thank you both very much. Great insights this morning. Really appreciate you both coming in. You heard there Alex Wong, who is director of Alex K.Y. Wong Asset Management, David Friedland, who's managing director for Asia Pacific at Interactive Brokers. And thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves, on my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Asian fund management industry consultant Stuart Aldcroft, Nick Marrow, lead for global trade at the Economist Intelligence Unit, and our US economics correspondent, writer and broadcaster Barry Wood. Bye for now.
Money Talk